for us a scenario for three sectors which you think will benefit from rising liquidity, plus the fact you mentioned that valuations have corrected substantially and therefore might have a better second half.
Yeah, so I guess I guess we are talking FY26 second half, right? Not FY25, because FY25 is more or less done. So the benefit will come only in the next year. So
Correct.
what liquidity does. So first is let's talk of banking and the BFSI space in general. So there, what the liquidity does is, so for banks, the worry was that we're not getting deposits. So once liquidity starts coming in the system, deposit growth will start to pick up. Second is interest rate short term. When interest rates come down, banks actually find a pressure on margin because you get an immediate repricing of your loans. Their rates go down, but deposits take a longer time to reprice, so deposit rates will go down with a lag. So in short, there's a reduction in your net interest margin. But what interest rate does is it boosts the economy. And you know that ultimately my NIMs are going to go up when the cyclical phenomena plays out. So that again helps the banks. Ultimately, it is like if the economy does well, then the banks start to do well because credit growth picks up. Second is your NPL scenario starts to get poor. And when we look at valuation, banks are in a sweet spot because it's
Yes.
probably the only sector which is trading at less than 10-year average valuations. Otherwise, everything in India still trades at premium. Like, valuations have become better, but they're not exactly cheap even today. They're still, and it's true across the world also, valuations are not cheap anywhere. So banks are like, very, very reasonable on valuation. So that's one sector which straight away does very, very well. The second sector which probably does well is, cement. So cement is partly linked to the fact that over the last few years, we've seen a lot of consolidation in the sector. So the big two have, taken over many of the smaller companies. Uh, there was a bit of pressure as this consolidation was going on because, at that point, you don't want cement prices to go up because you want to buy some of these smaller players cheaper. So you're okay with cement prices not really going up. But now I think we reached a stage where, if you think of telecom, the same thing happened in telecom. Once you became like two and a half players there, then tariffs started to go up. So we think from here, cement prices are probably going to go up now. And, demand will pick up because if you get liquidity, you get government spending coming back. And so, the demand scenario looks good. Capacity adds are going to be lesser than what your demand pickup is going to be. So, in that sense, utilization levels will go up. And in any sector which is more consolidated, pricing power is always there for the taking. So, last few months, we've seen cement prices hold up. Last 18 months, the scenario was cement prices would increase at the beginning of a month, and by the
And
middle
then
of the
come
month,
down.
it would be rolled back again. So now finally we are seeing cement prices hold up. And again, this is a sector which is totally immune from global. So you can't get cement into the country. You don't export much, you don't import much. So it's a very, very domestic sector. So, tariff wars are going to hurt it relatively much lesser than what we've seen in some of the other sectors. Now, the third sector would be to some extent consumer, and I'm talking of consumer in a very general way and not staples, because one is this year we're getting into the benefit of the tax break. So that 1 lakh crores of tax break which is coming to us, that is helping us. Second is in terms of consumer buying, uh, interest rates will start to come down. So for any consumer debt which you take, you'll probably start having lower interest rates, so it gets easier to service the EMI. So in general, the consumer sector will probably start to do a little better. Uh, we don't like the valuations in most of the consumer space. So it's a little challenge to find stocks which we think are adequately priced where we can make money on the valuation space. I think the staples is what will not really benefit too much. So staples is what we are avoiding out of that. So we tend to buy stuff in the consumer discretionary space more than in the consumer staple space. But even discretionary, not very cheap. In fact, what we tend to have there is more ancillaries to the larger players, people who supply some material to, let's say the white good manufacturers, or stuff
Okay.
like which benefit from Indian spending more on travel and
Okay.
tourism. So, those are the sectors which we really play over there.
If you like the video, do like, comment, share and subscribe.